Testing, sound check, system check. Thank you all for attending today's webinar, Microsoft Excel for Purchasing Professionals, a retention webinar. Today, we're going to be going over some basics, and then we'll be looking at how we could leverage Excel to look at the big picture and how our decisions as procurement and supply chain professionals affect the financial position of our organizations. So I just want to do a system check. Could you all see my screen and could you hear me clearly? If you could do so, if you could just send me a note in the message box, I'll deeply appreciate it. Awesome. Thank you so much. Thank you a lot of responses. Excellent. Thank you so much. Okay. So again, my name is David Millington, and I'm the Director of Education and Product Development at Next Level Purchasing Association. Again, thank you all for attending today's webinar. It's always a pleasure and an honor, and I'm very excited to jump right into this material. So we're going to leverage for our exercise today a bill of materials, a simple bill of materials, and we're going to just use the bill of materials and the price points for all the subcomponents. Okay, so on the left of the screen where I've highlighted is the current price points for parts F, B, E, C, A, and D. And we have the part numbers on the extreme left of the column. And the quantities that go into this assembly, in this case, part F, it'll be five pieces, and the unit cost is $15.11, and that's a total cost for that part in this major component or major product. The cost is $75.55, and that accounts for 38% of the cost. So for now, the information over here where you see 25, 15, and the savings targets, we'll get into that in a moment. But for those of you who need a refresher, we're going to start off and we're going to warm up this way and do a refresher. We're going to reconstruct this table on the bottom, and then from there we'll get into the bigger picture. And I hope today you all have fun and we learn a lot together from this exercise. Okay, so what I'm going to do, I'm going to copy and paste the part numbers and the parts, quite simple. And then you also copy and paste the quantities, and you would copy and paste the different price points. And what we're going to do here, we're going to input, again, part of a refresher exercise, we're going to input some of these formulas. Okay. So we have 5 components at $15.11 per unit, and that would be D16 times E16. So you put the formula in there, and there are a couple ways to do this. We could input each formula, but this is not efficient. Just picture having a long bill of materials, right? So we'll use the autofill function where we'll position our cursor until we see a cross, and then we'll drag down. So we carry those formulas all the way down. Okay, and then we're going to do here, it's another function. Okay, we want this to total. We could do it at least two ways, where we could put equal to this plus this plus this plus this plus this plus F21, and we get the total. Or the more efficient way to do this is to use the auto sum. Auto sum function is right here, and that will do it quickly and efficiently. All right, so we filled out the cost column, and we're gonna, in a minute, we're gonna come back to this. So I'm just gonna hide this column for now. Okay, so let us assume that our CFO came to us and he's noticed that our profitability, your profitability is diminishing, and the organization needs to be at least 10% net profit, or the net margin needs to be 10%. Okay, and I would always advise you all, and I've mentioned this in other webinars, especially the finance webinar that we did a few months ago, that is very important that as procurement professionals, we be totally integrated into the finance department and the enterprise across the board, that we don't operate in silos. We don't get bogged down within the walls of our procurement function, that we understand the procurement and supply chain functions in context to the bigger picture, which is part of this webinar. Okay, so with that said, it would be prudent, it would be wise for us to have a good understanding of the organizational position. So we would assume that this is the data points here, or the profit and loss statement for your organization. And if we look here, we see according to this projection, we're projecting at 8%, and then with 7% year 2, and 5% net profit margin year 3. So this is already, with this information, we already not meeting the 10% target. So I have a couple questions. So if we go back to this statement here, right, if we operate for the next fiscal year, right, with these cost parameters and these revenue projections, we're looking at about an 8% net margin. Okay, and the CFO, he set his target and he said that we need to operate at 10%. So the question is, what percentage cost reduction should we target as procurement professionals? Do we do a 2% cost reduction? Do we do a 5% cost reduction? How do we know? The only way that we could really understand and that question, and the only way that we could be effective as per that question, is to have a total understanding of all of the cost parameters, and to understand the cash flow projections, to understand our balance sheet. Okay, and we'll get into that in a bit, but to understand the total financial picture. So we're going to go ahead here. For now, we'll get into the P&L that I just showed you. We'll get into the cash flow dynamics. And we're going to, again, another refresher, we're going to construct these tables. We're going to construct them from scratch. Okay, and we would copy and paste this column, and I'll also do the same. No, we have a formula here. So build these out quickly. So we're looking here at, we want to see cause and effect. And this is why understanding the bigger picture and having the fiscal data, looking at the fiscal data points the same way that the CFOs and the people in finance look at the fiscal data is very, very important. So with that said, we're going to plug in the formulas here. So if you're looking at a 20% cost reduction on part F, then hold on one second. It's going to be equal to 20% of this. Okay, and then we will drag those formulas down. And then the new price, as we see here, we have 6044, which is a 20%. We'll bring it with 20% cost reduction. And we would, that formula would be equal to the original cost minus the savings. And that's how we got that. And then we drag this down. It's just a refresher. All right, we're going to copy and paste this. Bring this down. And then we're looking at a 15%. And I'm going to explain what this means in a minute and why we have that 15%, that 20%, and that 12%. Then at that degree of cost reduction, the new price or the new cost, total cost of that part as per this product would be 6422, and the same thing over here, right? I'm going to copy and paste. And then we'd apply the formula, 12%, this, and then we would drag the formula down, and then the same for here. That would be equal to the original cost minus this cost reduction, and that would be the new price. So we see pretty much our tables look the same. And again, we would do the auto sum, and we could copy and paste okay. All right, so that's our refresher. Okay, so now I mentioned in one of the webinars, the negotiation webinar, that we always have to be prepared for negotiations. We have to be prepared with a total understanding of the delivery dynamics, the quality dynamics, the terms dynamics, and our price points, exactly what our positions are. We have to have those mapped out. One of the worst things that we could do is to go into a negotiation and we're not ready. We go into, I always like to have my Excel spreadsheets available, because I've seen people negotiate with printouts, and then you go back and forth, and then the calculators come out. And once the calculators come out, it could be so prone to error. and to miscalculate and not have a total understanding of the big picture. A spreadsheet like this going into negotiation, you already have your negotiation target set out. In this case, a 20% reduction across the board would be the most favorable position, and then the 12% setting a cost reduction would be least favorable, and then in the middle would be the 15% if you set it that way. So it's always good to have at least 3 positions. Your primary position would be, of course, the most favorable to you, which would be the least favorable to the supplier. So the whole idea of having these other 2 positions is these are what you call fallback positions. Because in case you get some pushback or you have an impasse and you just can't, they're not willing to do this, then you have 2 fallback positions, and each one of these positions should meet the requirements, your company's requirements. So if 12% you manage to come across with a 12% cost reduction, of course, across the board, if that's going to bring it up to the original target that the CFO set for 10% net profitability or 10% net margin, then that's good. So your least favorable position should come across as favorable to your organization. So we're going to go into another tab right now, right, where you're going to pull this information into a driver, and that's here. So here now we have some of the bigger picture of the organization. That's why I say this is very, very important. So we're looking at monthly revenues for this organization, 7,500 units are sold, and at a price point of $425 per unit. Okay, and as we saw in the prior sheet, this is the total cost of the raw materials, and then we have the direct labor cost of $30 per unit, and this brings it up to $227.49, or a direct cost of 54% of the revenues. So we already know that if we operate at the current state, which is $197, as we saw from the other sheet, that's not meeting our requirements. Okay, the requirement is at least for the next 3 years to have an average of 10% net margin, and we've been tasked to figure out how we could realize cost reduction and savings to help the company meet those targets. So a couple things, and this is what I meant by leveraging Excel. Number one, we looked at being able to go into our negotiation, and we're assuming that we already had we sent out RFPs, we got the RFPs back, and then we working with the assumption that now we're ready to negotiate. Even after we got the lowest price point, we could still negotiate further to realize a better position for organization. So after we're assuming now that the first RFP, or the best RFP came in at $173, which was a 12% across the board. Okay, so let us see how that would affect the profit and loss statement. And this is what I mean by having the ability to analyze and to react and to be proactive as far as our negotiations go and how they impact the profitability of the organization. So we would H12. All right, so you're going to plug in that price point and see how that affects the P&L. H12. Okay, that's going to bring us down to direct cost of $203.79, and the materials cost was $173.79. So let's see how that affects our P&L. So we see right away that we are 12%, 11%, and 9%. I would recommend that we push further and let that supplier know that that's not acceptable. All right, and you see we have the capability to do it real time. Okay, and let's look at this position here, 167.87, and that was at the 15% reduction, and that's going to be G12. So we plug that in, we change the formula, G12, and let's see how that looks, and let's see how that affects our income statement. We in a better situation. So we see here for the next 3 years, year 1, year 2, fiscal year 1, 2, and 3. All right, we see we have 13%, 12%, 10% to 48%. But at least the directive was for the next 3 years to figure out, okay, how we could have minimum net margin of 10% on average. Okay, and I'm going to go back over here. Now, a couple things. And I've been in negotiations where, in reality, let us assume that we get 20% cost reduction. We may not get it symmetrically like this, 20% across the board for each item. So let's say we negotiate the supplier, the best he could do on part F is, all right, and we look at the big categories here. Just let me open up this column, unhide. Okay, we look at the big categories. Okay, so we see parts F, B, and E. Those are the parts that really make impact, because that accounts for what? And this is why I put the percentage column here. It's very important to understand that we focus on the critical few. This, to get a good cost reduction here, might be good, but it's not going to have the same impact as part F. Part D would be nice if you get a decent cost reduction, but again, it's not going to be as impactful as part F. Part F, B, and E account for what? Accounts for 91% of the spend in this bill of materials. So let us assume that the supplier pushes back, and the best they could do is 16% here. All right, and it works out. The best they could do is the initial counter offer. Let's say it's 19%, and then let's say this is 18%. All right, so it's very important that we understand the total average. So if you go into here, click on average. All right, so you see that even though we took a hit here, 4% hit, the total average was 19%, but we also have to guard against, these are like low spend. So in essence, we should do what we call a weighted average score here, because these are lower cost categories. So the 20% here, it's not significant. So let us see how this affects the income statement, and we're going to use this line. Go here to the input column. I'm going to come back to this would be, sorry, to be E. Oh, I'm sorry. It would be, sorry, F. It would be F12. And let's see how that affects. So even though we took a hit on that first on product F, we didn't get what we were looking for. Still, we were able to meet the requirement. Let's drive this down to 13, and let's see how that looks. 13%, still meeting the requirement. Let's see how this one looks, 15%. And to have this type of ability to really look at this and see how our decisions and how we negotiate impacts the big picture is very, 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 very important. Because we could get bogged down here and think we're doing well, and we're not looking at the bigger picture. Okay, so you see that had like a limited, let's bring the decimal points up. See how this here, let's bring this down to 17. Let's see how that affects. Let's bring this up to 18%. Let's bring this down to 18%. Let's set it this way. I want to bring something to your attention. So we see here, one, we have a 13.34 with this setting. Okay, so let us say all we could realize on part C, right? Part C here is 10% cost reduction. Let's see how that looks. 13.16 from 13.34. So to have this, again, to have this level of visibility, how this affects us year in, year out, and we could build a system like this. We could also look at it at the quarterly level, fiscal year 1, all the quarters, year 2 and year 3, to understand those impacts, and as well to be integrated into our cash flow mechanism, so we could understand how those different negotiated price points affect our cash flow situation. It's very, very important. So with that said, we could also look at other areas to target outside of raw material price points. So one of the things that I want to hone in on is labor. For example, we have direct labor set at $30 per unit. So many times, in most cases, our labor costs is mixed with work that's value add, meaning that there's a actual transformation of the product or service. The activities are done right the first time, and the customers are willing to pay for them. And on average, and I mentioned this in prior webinars, on average, most companies operate at about 10% value add, and about 60% non-value added waste. So steps in the process that add absolutely no value. So in terms of honing in, so we did this exercise and we honed in on raw material price points. We can look at our labor and to determine how what percentage, what's the distribution of our labor in terms of value add and non-value added activities. Okay, because that opens up a whole plethora of opportunity for cost reduction. And there's something else that I wanted to point out to us. When we look at this income statement, this is like a typical income statement. Okay, you have the revenues on top, the direct cost, which we just went through there with the labor and the materials cost. You have the other expenses, right? You have the earnings before taxes and depreciation, etc. The pre-tax income, net income. So this is a typical profit and loss statement. So, as I mentioned before, about 60% of the activities in an organization are what you call non-value added waste on average. But if you look at the typical P&L, profit and loss statement, it doesn't capture that. Okay, so in many cases, our processes in a manufacturing environment, we're bogged down by delays, right? Caused by maybe a supplier shipped us defective materials. And so you have folks in the production area, they're waiting for those materials, and all of those costs are just rolled up into what you call labor. So labor is a function of again, the value-added work, the non-value-added work, that in terms of wasting, unnecessary touching of products, or what they call over-processing, overproduction, generation of defects. And then there's another category of non-value-added essential. So things like what they call inspection, certain accounting procedures, they don't add value in terms of transforming the product from one stage to the next. And so they don't add value, but they're critical, essential functions that the organization must engage in order to operate their business. But those are not captured on a typical P&L. So my point is that if you're able to get information like this, right, where you have either a monthly or quarterly, right? You see we have the quarterly P&Ls here, or a yearly projection in terms of all of the what you anticipate for revenues, okay? And you put it into a sheet like this, the input sheet, you know, the amount of units you expect to sell per month. You can do it like that. You already know the cost per unit and all of the other costs. You know, it's very, very important that as procurement professionals, you know, we don't operate as silos, that we understand all of the other costs, and all of these other categories are fair game for us, you know, outside of the raw materials costs and those price points. So look, I have here miscellaneous expense, $35,000 a month for this scenario, this simulation, right? Are there cost reduction savings there? Then we have outsourced accounting, legal and accounting expenses. Are the opportunities there? Then you have office supplies, the opportunities here, right? And to be able to understand inflation, because this table accounts for 20% increase year on year on office supplies, okay? And to understand the cause and effect impacts of this on our profit and loss statements and our cash flow statements. So Excel could be a very, 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 very powerful tool to give us this type of visibility. For example, 13.34 here, and if you're looking at other categories, let us say that we get this down to 9,000. We negotiated it, we got this down to, excuse me, let's say 15,000, right? We put a handle on this miscellaneous expense. You know, some categories, some companies, it's huge. We managed to get a nice cost reduction there. Again, labor, if we dig into what degree of time, employee time is spent on non-value added activities, and to figure out how to get cost reduction from there, that is another category. But, you know, again, to have this visibility is important. So we did see here, we had a slight improvement in the margin. Okay, and then the second year we see 12.55, and if we're able to, again, to control the inflation, and we're sharp. Okay, bring this down here. That had a slight impact, but Microsoft Excel, my friends, use it. The whole point of this exercise today was, again, to give us a little refresher in some of the basics, carrying formulas, autofill, etc., but to how could we leverage Excel to be better prepared for negotiation. Then we saw how important it is to have flexibility to be able to crunch the numbers real time and to look at how each different position would affect our profitability, and to have the target, you know, begin with the end in mind. We knew in this exercise that that we were supposed to move from, I believe this was 8%, right? We got it up to 13.65%. So to have those objectives and those goals up front is very important. We knew that the request from our internal customer, the CFO, was to get the first 3 years at 10%, a minimum 10%, what you call net margin. And so in this case here, this was accomplished. So this, my friends, could also be leveraged. We could also put in there terms, payment terms, which would account for if the current request is net 14 and we request net 30, we could plug in the formulas there, right? We could build a matrix in addition to the material price, and we could see how that would affect the cash flow statements, of course, and we could see how it affects the income statement. We could see that impact. We could also look at quality in terms of the defect rate that suppliers come in with. So let us say the original contract was 97% defect rate, and you tell them, well, now I need you at 99%, right? We could also, in that case, we could look and see how moving from a defect rate of 97% to 99%, how that would affect the profit and loss statement. So again, it's very important for us to be totally integrated with the financials of our organization and to understand how our organizations, how our decisions impact our organization. I want to bring something to your attention that could be very, very useful when we're looking for categories for cost reduction outside of the price points. So we made up this table here, and it's based on what we call, I mentioned waste and cost reduction opportunities from waste, and the 8 categories: defects, overproduction, as I mentioned before, waiting, neglect of human talent, transportation, inventories, motion, and excessive processing, as I said, over processing. And we devised this table here, which could help you to help us to open our eyes and look at our organizations and see where could we find additional cost reduction opportunities. So in defects, we see here cost of shipping, supplier shipping defects, cost of production defects, cost of shipping defects to customers, overproduction, cost of shrink. If we overproduce, we have excess materials in products in store. Some of it we may not need, some of it may be exposed to expiration. So shrink, cost of shrink from expiration, cost of shrink from theft. The more we have, we're just increasing the probability that those products are fair game. And cost of shrink from damage, cost of shrink from just carrying over production, and the cost of negative cash flow. How something like this here, as a result of overproduction, would affect our cash flow statement. And again, to leverage Excel to build that model, that integrated model, where we integrate it into the P&L, we integrate it into our balance sheets, and we integrated it into our cash flow mechanisms. Inventory, some of the similar, what do you call it, cost drivers as overproduction, waiting, cost of waiting for late shipments, cost of waiting for changeover, cost of waiting due to rework. Also too, this type of mechanism here could be very, very, very helpful if we understand our yield and our scrap rate. And again, we build the necessary matrices in Excel, and we look at for cause and effect relationships with our income statement, how it affects, these decisions affect our balance sheet, and how they affect our cash flow position. So I'm going to open the floor for questions. I hope that, today's webinar was intended to be a little bit different, and the main takeaway was to be able to integrate our procurement activities and to integrate them with the financial systems, and to understand cause and effect, and to be able to work with the other leaders in our organization to see how we could realize cost savings. So Excel, it's a very, very, very powerful mechanism that gives us tremendous insight. I'm going to open the floor for any questions that you all may have. Let's see. Does anybody have any questions? I'm gonna open the floor for some Q&A. Oh yes, yes. I see. Christian asked me a question. Absolutely, yes, yes. We do this stuff for you. We're not just going to show you stuff, my friend, and not give you access. Not give you access to the material. All right, so I see, Neil, you have a question. What is the top number? Hold on. Sorry. What is the top number 1 and 2 type of waste out of the 8 types of waste? What is the top number 1 and 2 types of waste out of the 8 types of waste? I would say, Neil, that could differ by organization, and it could depend on a lot of factors. For example, let's go back to this sheet. I've seen processes where waiting was the biggest category. And I've seen other processes where motion and transportation were the biggest categories. So the whole idea is to look at your process. If you're looking at a transactional process, yes, this also applies to the transactional processes, by the way, or a manufacturing process. You look at, you map out the process, all the process steps, and then you look at each step in isolation, and you look at the activities, right? You look at the activities involved in executing a particular step, and you would do an analysis or a time study of how much time is spent waiting at a particular step, right? And then you would calculate the amount of time times the amount of people times the amount of the labor cost, the average labor rate. All right, so you're able to assign what you call process cost in terms of labor. Also to defects, shipping, as we see here, shipping defects to customers, right, could have a staggering cost, because if you ship a defect to a customer, now you would have had the cost to convert the product from raw materials to finished goods. Then you have the cost of maybe temporarily storing those finished goods until they're ready to ship. Then you have picking and packing operations. Then you have the logistics, so the shipping function. And then the cost. Now, if the customer says, I don't want this stuff, you need to, I'm returning it. Now you have the cost of the reverse logistics, right? And then now, then the customer asks for cost reduction for the inconvenience. So now you have to ship the product out again. And then on top of that, at a discounted rate. So let's say this, in terms of this example, you're already operating at a 10% margin. Imagine if a significant amount of the products, they have 2 or 3 paths to the product. And what I mean by that, the first pass yield, if 100% of the products could go direct to the customer, no defects, no problems, yes, that's the best situation, right? But if the products have to come back, be reworked, and then go back out, then the product had 2 paths to the customer. right? So the effects could be staggering as well, you know. So the whole idea is to look at your value chain, right, and dissect your value chain and look at these different cost drivers that are laid out here and look for the opportunities, because every time we ship defects to customers, it affects us as procurement professionals. Because if we generate a defect, we use raw materials that were procured, correct? So now, in order to meet customer demand, we may have to scrap those products, right? And we may have to utilize more materials, right? If you go back to the input sheet, we see, what do you call it? 7,500 units, if that was the demand, right? But in actuality, we had to ship out 7,000 or 8,000 units because 500 were defective, right? So that means that there's going to be a heavier pull on the materials. Our spend profile out there, the amount that we spend would escalate, right? So really honing in on these items, it does affect the procurement function. You look at overproduction. Every time the folks in production or manufacturing, they overproduce and stuff expires. Those are materials that we had to procure as procurement professionals, or things get damaged because maybe you have so much production in our storage grids that the space grids get constrained and there's product all over the place. And it's to move products from one point to the next is a difficult task. You know, I've managed warehouse operations, so I understand these things. And now we have damage of finished product that may have to be scrapped, and so all of this affects our spend profiles and the amount that our procurement function. Simple thing like turnover, right? The cost of separation, the cost of retraining. Every time we have turnover, let's say outside of the procurement function, let's say the logistics function or the manufacturing function, they have a high turnover rate. And because of a high turnover rate, you know, there's and let's say there's a significant learning curve, right, to figure out the processes. And then as a result of that, it creates a situation where we have a higher defect rate because you have new people learning the function, and they're going to get it right all the time up front. So how does it affect our spend? All right, so to look at all of these categories, quantifying them, leveraging the Excel spreadsheet, again, integrating these parameters with integrated block, as you see here in this spreadsheet with your P&L. You know, you could come up with so many opportunities, and Excel could really do that analysis and chart it out for you. This here was something that I showed prior as the process, and this was an actual process. You see transportation and motion in the process, and you were able to capture how much time, as I mentioned before, the labor rate, and you could assign cost to all of the waste parameters, right? And all these are target fair game, target for us, and we should do our best to form what you call category and commodity teams, where we have a team with folks from different parts of the organization, and we will look at opportunities for cost reduction outside of price. We did a whole webinar on that a few weeks ago. So I hope that answers your question. So again, it depends on the process. For example, just to finish up on that question, you may have a process that's configured in a way that it forces people it forces excessive motion and transportation because certain items are not at point of use. So in that case, transportation and motion could be a dominant what you call it, waste category. So the whole idea is to, every time I've done this type of analysis with different types of processes, I get different readings as to how in terms of the quantification of the waste categories. Because you have some companies that are very good at not shipping defects, but when you look at their processes, they're constrained with the other waste categories. So let me see if I have any other questions. On your, let's see, you had a question. Okay. Do we have any other questions? Okay. Okay, so I see Grant Lee had a question. How do you build these Excel spreadsheets? Well, I would understand your needs. For sure, I would say that the very, very basic requirement would be to have an income statement template. If you could maybe download the data points from your accounting department, they should be able to provide you with something like this, right? Simple P&L projection. Maybe this one, but you do it by the quarter, might be a little bit too much, but a simple P&L projection with the different categories. And then once you have that, then you would build your spend profiles, or you could use spend profiles or your bills of materials, and you would do the necessary links to realize cause and effect. Because, for example, this sheet goes into the input sheet that they're linked. See the formula here, it goes back to the spend, goes over here. So they're all, you make the necessary links so you could see the cause and effect scenarios. So it could be a little bit time consuming, but to have that visibility in terms of how you're impacting the what they call it, the P&L is very, 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 very important. I hope that answers your question. Jasmine. Oh, Jasmine, I see you have a question. I do not have very clear understanding how I can measure the cost of waiting. Okay, so the cost of waiting, let's go back to okay, so in this particular process, there was no waiting, but I've seen processes where people are the employees they're waiting for something. They're either waiting for information, or they're waiting for another process step to finish with their processing before it comes downstream. So you would have some degree of waiting, and a lot of times that happens when interconnected processes, they're not timed properly. So it's what you call a feast and famine. You know, sometimes you may have one process that is too quick, or another process that's too slow. And the best case scenario is where the products move across the process steps seamlessly, and we get into the issues of what you call, and that could be a point for another webinar, what you call understanding the takt time, which is the tempo and the rate at which a product should flow through a process or a process step. But they could be, again, this is observing, looking at the process, and a lot of times you would see people, in many cases, you would see people waiting for something, waiting for information, again, waiting for another process step, or they're waiting for materials. And that a lot of times could be a significant amount of time. How many times have you seen you look and you ask people, why are you waiting? I'm waiting for so-and-so to bring me the correct information, or I'm waiting for so-and-so to finish doing what they're doing. So that is indicative of interconnected processes not being effectively timed. And it could be indicative of push systems, where you have one process step, process A, for example, pushes on to process B, and sometimes process B, if it's not what you call efficient to handle the output of process A, then process A has to wait for process B to get all of the units processed before they send another wave. But where you have pull systems, and that could be, again, another touch point, another webinar, where you would have one process that will pull the other process. And when one process is finished with the activity just in time, the other process is sending what they need as inputs to execute their process. So it's well timed. So again, this has to be, observation with time studies, but waiting could account for a staggering amount of cost and time. I hope that answers your question. Any other questions? Donna, I see you had a question. Okay, no other question. Okay. I'm going to stay on for a little bit. Oh, I see a question here. I'm going to stay online for a few more minutes for any other questions. I hope you all found today's webinar helpful. And for those who are requesting the spreadsheet, absolutely. I had a question here from someone. I see Kells, you had asked if does the direct cost and indirect cost impact the cost of goods sold in the income statement? Yes, it does. It does. It would, depending on how you set those parameters, it would affect it. I hope that answers your question. Another question here, Grantley, when negotiating with a supplier, is it best to negotiate with products that will have the biggest impact on profit instead of all the line that you show, all the line that you purchase from that particular product? Trying to. Of course, the products that would have biggest impact should be your primary focus. If you could get savings across the board, then that's best. But I've seen suppliers in the past, they try to focus on or draw your attention to products that have a lower spend and try to give you a much better price point. I've seen suppliers use that tactic, but to have the good understanding of the percentage distribution and what percentage a particular product constitutes is very, very important, right? 80-20 rule, okay? So again, 20% of the product line or of your, 20% of your raw materials would drive 80% of your spend. And then 4% of your raw material inputs would drive 50% of your spend on raw material inputs. So that to have that laser focus in terms of and taking care of those big categories are very, very, very important. So doing some type of how should I put it, some type of weighting where you weight the impact based on the percentage distribution. As we see product or item part F is 38% over here, right, of the initial cost, right? It's 38%, and part D is 2% of the spend, so they're not equal. The primary focus, of course, should be in these categories. I'm not saying to neglect the other categories, but your primary focus should be up here. This constitutes for 90%, about 91% of the spend. Jasmine, I see the question. In some cases, you have a defined course, but what about the dead times? I don't know if you refer to those. Dead times, hold on a minute. In some cases, you have defined course, but what about the dead times? When you say dead times, Jasmine, you mean when you have periods of when your production is low, or you have downtime? Is that what you're referring to, Jasmine? I see Mini. We could email it for you to you. The this file, we could email it to you. I hope that answers your question. Kim, is there a course that goes over this in more depth? Goes over which component in more depth? The integration of negotiation and bill of materials with the fiscal statements, or the cost reduction categories that I went over with the waste categories. Are you referring to the waste categories, or just in general, Kim? Okay, so I'm going to stay on for a little bit. Okay, so Rington, I see you asked a question. How could you use this sheet to calculate loss of possible sales due to lack of resell material, or would it be a different sheet? So the whole idea, Rington, is to build out your matrix in terms of loss of sale and those parameters, and then integrate them into the appropriate fields into your income statement and your cash flow statements. So the same way we built this bill of materials model, and then we integrated it into, we linked it to the financial statements to analyze and to look for cause and effect impacts. The same way we could do it with the loss of sales scenarios. So the whole idea is to build that matrix out as a separate model and then integrate them into the fiscal statements. But I'm happy that I got you all thinking about, you know, integrating your activities across the board into those fiscal statements. You know, so this way we could see real time, you know, how certain settings, and it's all about system settings, right? We're making a total system, and we saw how we went through different settings, and how that those settings impacted the income statement. And if we're realizing our targets that were set. So to have that understanding, especially if you're in the midst of a negotiation, to have that ability real time, it's very, 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 very important. This way, if you're going to hit an impasse, you hit an impasse. You don't want to go below the line or not meet your targets. So yes, Ringtone, you would build the model for loss of sale, that scenario with all the parameters, and then you integrate that into the whole idea is to integrate our work into the three big statements, right? The income statement, the cash flow statement, right? And the balance sheet, to have that integration and visibility. And how a simple tool like Excel could help us with that. Oh yes, Jasmine. Yeah, downtime is it's an acronym. I hope it answers your prior question. It's not downtime as downtime per se, but it's an acronym. Okay, so that is today's webinar, and I would like to thank you all for attending. I could stay in line for a couple more minutes in case anybody else has any further questions. I will stay in line for another 3 to 5 minutes. I see Mike has a question. Oh yes, Mike, this could be emailed to you. Oh, I see I have a couple more here. Manish. Patrick, okay, thank you. Okay, Priscilia Longo, yes, we could we could send you the file and the recording as well. You could request the recording. Okay, again, thank you all for attending today's webinar. It was indeed a pleasure and an honor to share this information with you, and I hope you find it useful. And to those of you who have put in a request for the recording and for the spreadsheet, we will be more than happy to provide that to you. I see, well, I'll take one last question. I see, Sue, you have a question. Okay. Yes, Vince, you could get them. Absolutely. I want to make sure I get all the calls. Sue. Yes, Sue, you could get a copy of the recording. Absolutely, you could get a copy of the recording and the file if you want it. Okay. So this was fun for me. I hope you all had fun as well. And please give me some feedback. There may be a field where they would ask you for to provide us with feedback. We would deeply appreciate it. I personally will appreciate it. And thank you very much for your time and for attending. Have a great rest of the day. Bye-bye.